afternoon, ladies and gentlemen. Thanks again for joining this 1 hour session. And first of all, when you provide some feedback, I would appreciate if you would not provide any feedback on the technical prowess of the moderator as we go through this, as an audible was called and I have greater responsibilities than originally perceived. But that be it as it is. So I currently serve as the chairman of the Tampa-Hillsborough Expressway Authority. And today we have 4 amazing, talented people, and I'll go through their bios when each of them speak, but we're thankful that Hank Fishkind is going to be here, Tanya Langman, Ben Jonas, and Amy Lettler from THEA are going to talk specifically about areas about the current environment, the success, what rating agencies are talking about, and what the investor interest looks like, as well as what could be in the pipeline. So this is, and I would really be remiss if I didn't note that what Team Florida has been doing lately to deliver content in these times is extraordinary. And the rumor has it that this might be the best one that they've ever delivered. So we're happy to be a part of that. As we talk about and think about the last 6 months in our life, nobody has ever envisioned what it would be like to live through a pandemic and almost have the entire economy to shut down. But ironically, during this time, there have been some incredible opportunities to discuss around finance in the transportation business. Now, a couple of weeks ago, I had the opportunity to, and thank you for noting the Lightning win last night, but a couple of weeks ago, I had the opportunity to sit down with Jeff Vinnick, the owner of the Tampa Bay Lightning, and we were talking about a bunch of things, and we asked him about the new normal. We said, Jeff, what do you see as the new normal? And he had probably the best answer I think I've ever heard. And he said, there is no new normal. There's a transitional normal right now. And in his words, not mine, I promise you, when we get through this, the economic boom that this country is going to experience will be second to none. The pent-up demand that we're going to see between people traveling, infrastructure projects that are going to be brought back online, putting people to work. So let's not keep using this term of new normal. Let's think about this transitional normal and making sure that in our personal lives, as well as our professional lives, that we are prepared to seize the opportunities that are going to be presented to us either right now because of this interest rate environment and appetite by investors, or 6 months and a year from now when we start coming out of this, what we could possibly do with additional funds. So we've got a series of experts in the financial industry to talk about the economy, expectations of the financial community, interest rates, and then we're going to review a little bit of a transaction that THEA did to give you an idea how that came about. So I think we're all familiar that the interest rates are very attractive right now for bond issuers, both tax-free and taxable. Many investors are eager to participate in these transactions. We've gotten direction from the rating agencies themselves. They're out there in the market, these transactions, and as I said, we're going to conclude with THEA being one of the beneficiaries of this new market. In August, we sold $20 million of tax-exempt new money and $200 million of taxable refunding. We received tremendous support, tremendous interest, and as an organization able to reduce some of our cash flow obligations going forward while taking on a few different projects. So before we move to Hank as our first panelist, and before I give you a summary of his incredible background, I want you to think about this question, and there'll be a poll put up, and we will review these results at the conclusion of our first presentation. But the question would be, how many public toll authority ratings do you think have been downgraded by the rating agency so far this year directly as a result of this pandemic? So when you can, take your time, answer that, and we'll release those results at the conclusion of Hank's presentation. So first up, Hank Fishkind. Hank is going to give us a broad overview of the economy and the recovery, both nationally and here in Florida. He'll provide a backdrop for upcoming speakers who will focus on the financial markets. Dr. Fishkind earned his PhD in economics from Indiana University and has worked in the public and private sectors. Hank formed his own full-service economic and financial consulting company, was a founding member of 2 publicly traded real estate development companies, and recently joined PFM in 2019 after selling his financial advisor consulting and real estate company to PFM. Hank, if you wouldn't mind, please share your thoughts on the economic outlook and how investors are looking at the economy and municipal bond credits both nationally and in Florida.
Vince, thank you for that introduction. Appreciate it. Thanks all of you for joining us. And Vince, could I have the first slide, please?
Yeah, we're going to attempt to make that happen.
All right.
Attempt is the operative word, okay?
Oh, that's all right. You know, this is the dismal science, so if we have a little break before we get to dismalness, it's not too bad. If you could have the next couple of slides, Vince, so we could get to the content, sir.
You don't see anything up here now, do you?
I do. I do. You're doing great. Stop right there. Next slide, if you would. There you go. I think what's terribly important about this is that this is the first ever services sector recession. This has triggered one of the worst recessions in U.S. economic history, but it was caused by something very different. Every other recession in the past was a goods-based recession. This being a service sector recession, it's caused a very sharp loss of employment and income in the services sector, and many of these businesses are relatively small with small capital bases, and their workers typically don't have social safety nets. So the result of this is a very different trajectory than what we're used to in recessions. Since there is not a buildup of inventory as there is with a goods recession, we're getting a recovery trajectory faster, but at a very differentiated rate. So if we could have the next slide, Vince. So I'm going to give you both a baseline and a pessimistic view. In the baseline, as I said, this COVID-19 recession is very severe, but potentially the shortest recession ever in U.S. economic history. We are having a gradual reopening, and you know, we're going to have some periodic rollbacks as this goes forward. But so far, it appears that at least with reasonable masking and social distancing, the economy can operate at this lower level of economic activity. Of course, we could have something a little worse, and that's the pessimistic trajectory. But in terms of the baseline, we can go to the next one, Vince, it's fine. In terms of the baseline, baseline here in blue, and what you see is a dramatic downturn right here, almost at a 40% rate, and then a significant rebound in the quarter we're in right now. But this level of activity and growth can't be sustained. Also, arithmetic's a little important here. If we have a contraction down 40%, and we have a recovery even up 40%, which isn't going to be, doesn't mean you get back to zero, right? You go down 40%, you come back up 40%, you didn't get back to 100. So on the right, you see the cumulative trajectory. So it's really going to take until late next year before we can get back to where we were, and that assumes that we have a vaccine widely distributed beginning next year. We have the next slide, Vince. So interest rates are going to remain very low. The Fed has said, and here's the federal funds rate in red. That's the only interest rate on this chart the Fed directly controls. The Fed has clearly said that they're going to keep rates very low for a long time. And that's going to keep the 10-year quite low and keep the whole panoply of mortgage rates and 10-year and 30-year all down at very low levels. And so the result has been very interesting in terms of the impact on the economy. We have the next slide, Vince. So just to put this in perspective, if you look at this COVID-19 recession, it is clearly the shortest of any recession with just 3 months of duration, but it's very significant in terms of the fall in total GDP. And but for the strong actions by the Fed and additional stimulus of over $3 trillion, this would have turned out far, far worse. But we will have a very short duration cycle. But there are significant consequences, both in the short term and the long term. We have the next slide, Vince. You can see that this impact is very highly concentrated in certain metropolitan areas. The composition of activity depends and has a great impact on how bad the recession is. Those areas with substantial amounts of tourism and travel like we have in Florida, especially in Orlando, are much more affected than other areas of the country. We have the next slide, Vince. Just to sort of put a highlight on it, you see the weakest sectors are accommodations and motion pictures, but yet we have very strong sectors where we've had very significant job growth already during the course of this recovery. So a very differentiated effect across industries and across geographies. And that's something very different than any other recession we've had. We have the next slide, Vince. And on top of all of this, I think what's happening that's terribly important to think about going forward, as Vince said, is what are the implications? Our economy was experiencing substantial structural change before this COVID-19 recession. The recession has had the impact of greatly accelerating these structural changes that were already largely underway. We have the next slide, Vince. History is a good guide to the future until it isn't. And as Mark Twain said, history doesn't repeat itself, but it often rhymes. Useful, but when you have major structural change, history isn't such a great guide. And we've had that. This past decade has given rise to substantial globalization and expansion of international trade. We've had an incredible increase in U.S. energy production, artificial intelligence, and a tremendous concentration of wealth. And the result of all those things is that our average rate of growth going forward is slower. We have a lower inflation rate and much lower interest rates going forward. We have the next slide, Vince. And so I want to put a couple of points on this. So we know that retail demand and the demand for retail space was already shrinking well before the COVID-19 recession. We know that e-commerce has caused a dramatic reduction in the relationship between the amount of households and the amount of retail space that is supportable. And so here's a little example from Florida from data that we worked up. From 1980 to the year 2000, each person in Florida supported about 50 square feet of retail space. But over the last decade, that contracted to only 37 square feet of retail space, as we saw e-commerce eating into the demand for community and regional mall space, which could be delivered by e-commerce. But neighborhood grocery stores as yet weren't eroded at all. Post-COVID, what we're seeing is a small erosion in the demand for grocery and neighborhood space, but a sharper reduction again in community and regional mall space. So if total supportable square feet goes from 50 to 24 square feet of space, that means there's an ocean of obsolete space that has to be digested and reused. It has a dramatic effect on the volume of new investment in this space. It has a significant effect on tax revenues for local governments. Could we have the next slide, please? Same thing now is happening in office. We used to think that between 1980 and 2000, each office employee needed about 250 square feet. Then we moved to cubicles and open space, and that shrank significantly. And now that we have work from home and it's been demonstrated to work, and that many employees really like that, we're going to see significant amounts of work from home and hybrid space going forward. Many firms are going to want to economize on that space, and only the very best or the very cheapest space is going to compete very well. So we are going to see a dramatic shrinkage in this space as well, with consequential effects for locational patterns and consequential effects for tax bases too. We have the next slide, please. And so you can see now that this has big effects on GDP. The average rate of growth has downshifted from over 3% from 1970 to 2000 to about 2% over the previous decade, and now it's going to downshift even more because of the structural changes that I described to you a few slides back that was accelerated by COVID-19. We have the next slide, please, Vince. So there's significant impact of this on Florida. Next slide, sir. So you might say, why do I care about GDP? I mean, did you sell any GDP this week? I'd like to sell GDP, but none of us get to do that. So why do we care? The reason economists spend so much time talking about GDP is that it's a great overall measure of U.S. economic activity. And our Florida gross state product is highly correlated with the trajectory of GDP. The correlation is almost 90%. That means that almost 90% of the variation in Florida's gross state product over a business cycle can be explained by US GDP. Notice also that the amplitude of the Florida cycle is bigger both on the upside and on the downside with US GDP. So with the contraction, Florida contracted much more deeply, and now with the expansion, Florida is going to expand more rapidly. We have the next slide, sir. Florida's economy, importantly, Florida's economy was already slowing down well before the COVID-19 recession. Our population growth peaked in 2016, as you can see here. And in 2017, 18, and 19, population growth slowed because we had a slowing of migration, both international migration and domestic migration. So even prior to the COVID-19 recession, our economy had already slowed down from average growth to below average growth, as you'll see on the next slide. If we could have that, please, Vince. Thank you. So employment growth obviously has slowed significantly. Over the last 12 months, our employment growth is down almost 500,000. It was down almost 1 million, so we gained half of it back so far. But we gained back most of the employment in the sectors that are the easiest to gain it back. You can see still leisure and hospitality and those things related to it are still severely depressed. And it's depressed the areas of the economy. It's caused the highest unemployment rates in the places with the most tourism. We have the next slide, please. And so looking forward now, population growth and employment will be very slow. We have a big reduction in employment on an annual basis for 2020. We'll see a modest recovery going forward, but it's going to take some time for Florida's economy to fully recover because of the structure of our economy being so heavily based in tourism and travel. Next slide, please. And so just a little disclaimer, PFM says don't bet the ranch on our forecasts, but we hope you found them informative. Thank you, Vince.
All right. Hey, thank you, Hank. There was one particular part of your presentation, so I'm probably going to step out, but I need to ask this question because
Sure.
you actually, I'm wondering if you might agree with me on this. So you talked a little bit about migration trends being down. You talk about a new trend to work from home workforce, right?
Right.
Spaces, commercial real estate space needs. So Florida is a tourist, leisure, real estate, which all depends on roads, right? We need roads to move people around.
Oh, yeah.
So in Tampa market where I live, I'm actively involved in a couple of organizations, and we've always struggled to attract these companies to relocate to Florida. And we're talking about, low taxes. We all know the reasons. And we always get those pushbacks to say, I don't want to relocate 1,000 people or 1,500 people. We just don't have the expense we don't have the money to do that. The cost savings, yeah, we get that. But it's just a big interruption to our business. So my question is now, as we're all saying, this pandemic and relocations to Florida may be on the back burner, I'm just wondering if it actually isn't the inverse, in that companies are going to say, I don't have to move 1,000 people.
Right.
I only have to move 25. My senior leadership team, which are the people who bring the biggest money, the biggest impact, or add that with all those employees who say, well, if I can work from home, I'd rather work in a state where I'm not paying income tax. So do you not think we may see somewhat of an acceleration of smaller relocations and even more people coming to Florida than we thought about that, 1,000 a day number?
Oh, yeah. Yeah, it's just going to take a little time, but that's exactly right. And we're already beginning to see that. And to your point, I mean, why work from home in Trenton, New Jersey, if you can work from home from Tampa, Florida? And so there's going to be a substantial amount of that for that part of the economy that can make the move. Lower wage service sector people aren't going to be able to do that. So a very bifurcated kind of situation. But yes, we'll get more than our fair share, to your point, Vince. I think that's exactly right.
So we might need more roads. Okay. Moving along, next we have Tanya Langman of HNTB to provide the rating agency perspective. Tanya is the Director of Financial Services in HNTB's National Advisory Practice and works with transportation clients throughout the country, specializing in the toll and aviation industry. Tanya has 15 years of credit experience from previous roles at rating agencies and bond insurers, including serving as the lead toll sector analyst at Fitch Ratings. Tanya brings her specialized credit and financial expertise in the development of feasibility studies, financial plans, and delivery options to assist clients in implementing and funding capital projects. Tanya, we look forward to hearing from you.
Thank you, Vince, and thanks for that introduction. I'm delighted to be here with you today for this, what I consider a very important and timely discussion. As most of you probably know, soon after the pandemic hit, all major rating agencies issued negative sector outlooks on all transportation sectors. And they did so to signal to the market that there is a severe decline in overall activity. And this negative outlook really extended to all sectors, including toll roads. So earlier today, Vince asked you to answer this question. How many toll road ratings do you think have been downgraded by the rating agencies so far this year directly as a result of this pandemic? And your options were A, the vast majority of ratings, B, about half of those ratings, and only a handful under C. So Barbara, let's see if we can pull up those responses. Okay, good. So it looks like most of you, or 69%, agree that only a handful of ratings have been downgraded, while about 21% believe that half of the ratings were downgraded. And fortunately, the answer is that it's only been a couple of downgrades, or only a handful of ratings have been downgraded so far for the toll road sector. And this is primarily because many of those agencies came into this crisis with strong liquidity and financial flexibility. So that allowed them to withstand severe revenue shocks, and rating agencies are expecting them to maintain adequate metrics that are still in line with their pre-pandemic ratings. So this is certainly very encouraging for the industry. And while we're seeing some positive signs in terms of what Henk just talked about, economic recovery is starting to pick up and some traffic recovery, there's still a lot of, or unprecedented level of uncertainty with traffic and revenue forecasts. This is something that is really important for everybody to understand. As toll authorities navigate through these challenging times, understanding what the rating agencies and investor expectations are can really help them make informed decisions. So I know most of us at least intuitively understand bond ratings, but to kick off this discussion, I thought it would be useful to quickly go through some basics. Now, Vince, if you could please go to my next slide. The one after, yeah, perfect. So what are credit ratings and why do they matter? Most ratings are issued by the nation's top 3 rating agencies. It's Moody's, S&P, and Fitch. And these agencies are typically solicited by the borrower to provide an independent assessment, objective assessment of their credit worthiness, which is essentially the likelihood that the borrower will be able to make timely payments and full payments on their debt obligations to bondholders. In the case of toll roads, those payments will be made from future toll revenue. So all agencies have published rating criteria, and in the toll road space, it will be sector-specific toll road criteria that they use as their analytical framework to arrive at a rating. And they have a rating scale that goes from investment grade ratings starting at AAA down to BBB categories, and then below investment grade ratings. It's everything speculative below BBB, starting with BB. So the higher the rating, the lower the risk of payment default to bondholders and investors. So most public authorities are actually rated at the investment grade level or higher, and only a handful are below investment grade. And what do these ratings tell borrowers and investors? Well, for borrowers, lower rated bonds generally mean that investors could require a higher yield to compensate them for that additional credit risk that they're carrying. And that could result in potentially higher borrowing costs for the borrower. This means less money upfront with bond proceeds for capital projects and less excess toll revenue after the payment of debt service over a long time period left for critical spending. So there's a direct relationship between ratings and financing costs for a toll authority. Now, investors will look at credit ratings to guide their investment decisions, depending on what their appetites are. So if we shift gears to the current environment, since demand is one of the primary rating factors for toll roads, some of the most commonly asked questions in the industry for the rating agencies, primarily from bondholders and investors, but also coming from the borrowers themselves, is what rating agencies believe would be the course of the recovery. You know, how will traffic evolve over the near term and over a longer term? Because a lot of that debt is 30, 40 years out. So I think in anticipation of some of these questions, rating agencies have been incredibly transparent since the start of the pandemic and issued numerous reports and publications and articles that hope to answer those type of questions. And HNTB has had extensive dialogues with all of them and continuing those conversations. But for the benefit of this discussion today, I wanted to provide you a sample of their articles and highlight some of the key takeaways that at least I picked up from these. So if we go to the next slide, you'll see some of those articles listed here. And I'm going to start with Moody's, the report in April of this year, soon after the severe declines came through. They published in their base case stress case report that they believe toll revenue will be down 30% from 2019 levels by the end of 2020 for public toll roads, and 50% down for all privately managed toll roads and dynamically priced managed lanes. And even with those extensive 30 and 50% revenue declines, it's not even a traffic decline, it's revenue decline, with some cuts in O&M, they believe that ratings will be held at their current levels because of the adequate financial flexibility that is still expected to remain at, notwithstanding these declines. And Moody's also published another report later in the summer, in July, talking about resiliency of commercial traffic through this crisis and how they see that traffic is offsetting some of the passenger-related revenue losses. They do believe that commercial traffic will trend with GDP growth. So as Hank pointed out, some of that recovery will take longer, and slower, but they have cited the resiliency of that particular traffic base. So S&P in June also issued a similar report talking about that they believe roads will need at least 12 months to recover, and they're making distinctions between some regional and asset-specific variations, and all rating agencies do that as well. So this is very generalized. But in their view, by the end of this year, by the end of 2020, traffic will be down between 15 to 30% compared to 2019. And by the end of 21, it'll be about 5 to 10% below 2019 levels. So about a 2-year recovery with most traffic coming back in 2022. And Fitch, finally, they also published a set of reports in July. And what they do is they group toll agencies into 3 subcategories based on their demand characteristics. So they have the large networks, which are your turnpikes and expressways, small networks, which is more of a single toll road or standalone bridges, and managed lanes. And they published individual sector-specific or subcategory specific stress case scenarios that include both the rating case, so the case that they rate to, and also downside scenarios showing various degrees of declines in traffic and slower recovery. So the rating case, for example, for both small and large networks shows that traffic will be down about 28% compared to 2019 levels by the end of this year, and full recovery is expected by 2022. And with these additional downside scenarios, what they do is they stress the resiliency of their rated portfolio to see that if that assumption does not pan out, and there should be even deeper declines in traffic and slower recovery all the way to 2024, what would happen to the rating? And under these unlikely scenarios, they think that they don't expect downgrades extending more than 1 to 2 notches. So even under really stressful environment, they still believe that ratings are relatively resilient. There could be some downgrades, but they're not necessarily going to be severe. And the rating agencies don't just look at the shorter term forecasts, they look at longer term outcomes, recognizing that there's going to be potentially some permanent out year shifts in demand. And one potential consideration is that there will be more permanent shifts in commuting behavior, particularly in the areas where telecommuting is prevalent, again, supporting some of the factors that Hank discussed with his economic outlook. So This is something that we might want to consider with management forecasts and CNR studies, looking at the areas that are more prevalent to telecommuting. And interestingly enough, Moody's published in one of their reports in July that they believe there's an opportunity for improved operations through all electronic tolling. In fact, the report said that toll facilities with no toll collection maintain higher operating flexibility through COVID, and cost savings from transitioning to all electronic tolling can actually balance out some of the losses that they expect in the long term from that passenger shift with reduced commuting traffic. So, we all understand that rating agencies, this guidance is super insightful, but it's definitely not something that it represents a forecast. They're not in the forecast business. So what they do is they evaluate management's forecast, they evaluate traffic and revenue studies and economists' views, and they use that as a baseline for evaluating a range of possible outcomes and scenarios. And so as my former boss, and I don't know if he's here today, Chairman George, would say that despite commonly held opinions in the industry, credit analysts make every effort not to simply assume the worst. They really rely on the information the toll authorities and their independent consultants provide them. So being able to explain these forecasts, support some of the assumptions, and explain management strategies and policies with full transparency would be very helpful through the rating process. And as toll authorities are planning through these really uncertain times, many will question affordability of the capital improvements and ability to access capital markets. But I would really encourage management to remain nimble and continue to look for opportunities through this transitionary period, as Vince, I really like that transitionary norm that could position them better for when traffic does return. And if anything, we've learned from this crisis is that there's inherent resiliency in toll roads, and there's always going to be a need to actively plan for the future. So I'll take questions at the end, and Vince, back to you.
Thank you, Tanya. I find it interesting that I think you were quoting a former boss who said something to the extent of that the rating agencies relying on a good interaction between the authorities and your financial analysts to tell them the story about their particular organization. I would say our experience, or at least mine, in participating in some of the pitch sessions was very interesting how rating agencies can be very different in what they want to know. One, I recall one was extremely analytical, really wanted the database, wanted to get behind every number, and the other really just wanted to talk macro, what was going on in the area and the community and the trends. So it's just important, I think, the message here, I think it's important that people know who their audience is and make sure you get the right resources to communicate your message to that audience so it's received in the way you hope it is. And in our case, I like to always ask for upgrades every time we meet with the analysts, despite the market. So you can do that if you have a good story. Thank you. So before we turn over next to Ben, we wanted to do another poll question. And I assume that's going to pop up any second. But very simply, have you refinanced your house in the past year? And I think the question could probably be rewritten to say, how many times have you refinanced your house in the past year? Because there have been opportunities. In my primary industry, I'm in the title insurance. We've had people in here twice in a year refinancing the same home as rates have done that much of a drop. So we'll share that information with you towards the end. But next, I want to introduce to you Ben Jonas of JP Morgan. He's going to provide the banking and capital markets perspective. Ben joined JP Morgan in 2004, and he's an executive director in the public finance group, working with transportation and infrastructure clients on financing and advisory assignments across infrastructure asset classes. Prior to joining JP, Ben was an M&A specialist in the transportation sector. I think, Ben, you're going to talk to us about the historic lows of rates and what we're looking forward to, right?
Yes. Thank you, Vince. Great. Well, thank you very much. And as the previous presenters commented, thank you to Team Florida and HN2B for putting on this presentation. As Vince kicked off with the question, I'm eager to see the results of the latest poll. And I think in many respects, The answer to that question very much resembles the conditions of the financing markets in kind of the post-COVID environment, and also has parallels to the transportation finance market as well, which we'll spend a few minutes going into here. I'd say at a high level, there has been within certainly the municipal capital markets and the broader investment grade and markets in North America and beyond, a very significant rebound in the market since the depths of really March and April of this year. And although it took a little longer than other sectors to rebound, transportation, and by that I largely mean volume and revenue-based assets and enterprises that access the long-term capital markets, there has been a rebound, and really starting midsummer and picking up over the last several weeks and heading here into the fourth quarter. And I'll spend a minute on pipeline later. And then, although I'll focus on some of the macro factors that Vince pointed out underlying the current market, part of the reason for the delayed impact and pipeline of relevant assets that we've seen in the market is it takes a lot of really time and thoughtfulness to plan a transaction to come into the markets. We heard from Hank on economic fundamentals, Tanya on kind of rating impact and considerations, and I'll talk a little bit about market factors. But bringing all these factors together into a marketable transaction, given the need to digest and think through the impact, both short-term and long-term, of these variables, has really been the kind of the key driver for transportation agencies evaluating coming to market. And of course, with the next section, I'll turn over to Amy, who will walk through what the organization at THEA was able to do by being the first transportation toll issuer in Florida to kind of bring all these pieces together and successfully enter the market since the onset of the COVID pandemic. So walking through the factors that I'll focus on, one being interest rate environment, two being investor appetite or interest in the market in accessing tax-exempt or taxable transportation and toll road paper, and then a pipeline of transactions to come in the financing markets. When it comes to the interest rate environment, I think that's really the headline. That's just when you really take a step back and look at things, it's in some respects quite shocking. I think being in a period of relatively low rates over the last 15 plus years in many respects, and as Vince mentioned with title insurance and seeing repeat borrowers when in terms of home refinancing. You look at the headline numbers of 10-year U.S. Treasury in the mid-60s, which is down, about 120 basis points since the start of the year. So a third of the level that they started the year at, which is really just quite stunning. Similarly, MMD, which is the municipal benchmark that tax-exempt transactions price off, saw all-time lows in August as that market rebounded. And I think the word of this panel is transitionary norm, if I pronounce that right. And I think hard to say when it comes to rates if this is here to stay or part of a transition to a new normal. But the FOMC has indicated a likelihood to keep rates on hold for some time based on various economic factors that they are observing. So why does this matter if you're a transportation issuer or an authority, looking to evaluate coming to market? One is, from a historical perspective, these rates are unprecedented. So there's rationale to evaluate, savings through refinancing in terms of capital planning for new borrowing or planning ahead for new capital plans. Most transportation capital plans that I see are planned with 5%, maybe higher interest rates over long periods of time. So if you're coming to market, accessing the market at 2 to 3%, that's quite attractive to be able to come in so far below what your long-term forecasts probably have previously assumed for long-term interest rates. So there's the benefit there, which doesn't always offset the potential for significantly decreased revenues. But if that's a temporary event and you're borrowing for 30 years, there's significant upside of evaluating market conditions now to lock that in for what essentially are 30, 50, 100-year assets that are being financed in some cases. In terms of investor appetite, investor interest, it is very clear and well demonstrated, that the markets had a very challenging time in March and April. That was pretty much universal across all markets. But focusing on the positive here is, from a kind of macro perspective and looking at the municipal market, which is the primary market of focus here, we look at inflows and available supply of bonds, and between June and August we saw $35 billion cumulative of inflows into the market, and another measurement we call net supply was negative. In other words, through that same time period, in other words, there was less supply in the market for investors to purchase than the sum of what they had to reinvest of bonds that were maturing or new issuance in the market. So the market dynamics have become much more favorable certainly than they were in the spring. And I think with that, and I think hearing some of the comments from Hank and Tanya, what we really saw was really strong interest in the long-term nature and essentiality of these assets. So I'll close with pipeline of transactions. We've seen roughly $2.5 billion of toll road offerings since the onset of the pandemic. Really nothing in March and April. A smattering of really AA deals with very long track records, for the vast majority of the summer. And then, over the last month, we've seen, single A rated single assets, as well as a couple BBB rating category offerings that have all, cleared the market and seen strong interest. So, I think in conclusion, strong factors contributing to increasing issuer confidence to prepare deals to come to market and access these historically low interest rate environment. So thank you very much, and happy to answer questions at the end.
Thank you, Ben.
In the interest of time, unless Vince wants to have a do-over.
No, I'm good. Go, roll.
Got it, thanks. Can you please screen forward, sir? Thank you very much. I'd like to thank Team Florida and HNTB for including me on this panel. And I'm going to take all of the intelligent and useful comments from the experts on this panel and bring it down to what Thea's experience was recently in the market. And so on the first slide, the steps we took to get ready for the market. When COVID hit, we were supposed to be getting into the market. So obviously we had to step back without being able to get traffic and revenue projections as historically are necessary to go into the market. But we did engage our traffic and revenue consultant to provide traffic and revenue projections during the work from home period, known as estimates. We produced a conservative fiscal year 21 budget in light of the expected lower revenues. Prior to the fiscal year end, we defeased our 2012 C bonds that were to mature in 2021 to improve our debt service coverage ratio. And we have developed a 6 and 10-year work program that was consistent with the recovery projections. Next slide, please, Vince. So this is a busy slide, but you guys can focus on that while I'm kind of explaining what we did. Or not we, Stantec is our traffic and revenue consultant. They developed a model for Thea that provided scenarios with different projections based on the length of recovery. They were duration scenarios. So the forecasting methodology utilized historical employment trends, COVID-19 impacts on the employment sector, and historical work from home statistics to develop an employment model. They had a calibrated regional travel and demand model that they've used over time and took that all together with Thea traffic and revenue data and collection statistics. And with this methodology, they were able to develop traffic and revenue estimates, not forecasts, based on scenario. Next slide, please, Vince. So the estimates were based on employment recovery analysis with a short duration scenario allowing for a quick pickup of jobs and lower work from home percentages, a mid-duration scenario with a slower recovery and more work from home, and a long duration with a recovery similar to the Great Recession and a larger share of folks working from home, a little consistent with what Hank was mentioning in his presentation. We're basing traffic recovery on non-work from home employment recovery, and this shows the timing of recovery of non-work from home employment levels by scenario. So the short duration estimated to recover by end of calendar year 22 and long by 2025. Next slide, please, Vince. So the TNR forecast we used to develop this financial plan, it showed the stress points in our debt service coverage in earlier years with the expected lower revenues per the estimates. We adjusted our work program to advance a project that improved near-term service levels and ability to defer more expensive improvements to the outer years. Accelerating those elements and deferring the more expensive improvements that will be needed in the future pushed $67 million out of our 6-year work program. So for the upcoming 10-year horizon, our future debt financing was originally estimated to fund 56% of our work program. By issuing $25 million in new money just now to improve our near-term service levels, our future debt financing was reduced and estimated to fund 35% of our $940 million work program in the next 10 years. Next slide, please. So the rating agencies took a deep dive into how the scenarios were developed, as well as how we used the traffic and revenue estimates to prepare a conservative 30-year financial plan. We used the mid-duration scenario revenue estimates and developed the cash flows to determine our ability to use pay-go cash for most of our work program and where we would need additional financing. One rating agency went deep into the analysis used to develop the financial plan, asking questions about specific projects and how they would affect the traffic and revenue during the recovery. The ability to see 3 different scenarios provided them the background they needed to affirm our rating and provide us with a stable outlook. The other agency focused on the cost of our work program, including R&R and how strong our debt service coverage levels were. They affirmed our rating and gave us a negative outlook because the entire toll road sector is on negative outlook. Personally, I believe we made a good case for getting an upgrade, but I'm sure Vince will ask for it next time. Next slide. So our pricing results, based on the tremendous demand for the 2020B taxable refunding bonds, the team was able to lower spreads by 5 to 15 basis points during pricing. The refunding of the 2012A bonds resulted in a net present value savings of $32 million, or approximately 17% of the par amount of the bonds refunded, which was almost double what we were expecting and had presented. This credit goes largely to my friends at JP Morgan, who were the senior managers on this deal, and PFM, who was our financial advisor on it. An important thing also that happened for our pricing is we were getting ready to hear some Fed comments from Powell on Thursday, expecting to price on Thursday. And our bankers were able to get us into the market early, a day early, went ahead and said, let's jump, let's go. It's important to be able to do that just for that very reason. What's this going to look like? Is it going to affect the market? And we were able to do very well. So our combined transaction generated $25 million of proceeds to advance capital projects while still lowering our annual debt service by $1.2 million from fiscal 22 to 2037, which are pretty good results. And as one banker said in their note to me, when you can complete a taxable transaction with a final maturity 17 years in the future and every maturity has an interest rate well below 3%, you know you've done well. So anybody can reach out and find me. I know we're running out of time and I know we want to get to question and answers. I'm happy to answer specific questions about our experience. And thank you for your time. I'll kick it back to you, Vince.
Thank you very much. There's one open question. It says, I can't hear Vince. So I think we've answered that question. So we're 1 for 1. I don't see any other questions up there yet. I'll wait for a few to come in, but I've got one. If Hank, if you're still with us, I'm curious on, Hank, I see you're muted and now you're unmuted. Great.
I am here.
So I guess part of the reason I'm going to Hank is I'm an economist and not a PhD, but I studied economics. So I can remember when I started my business, I was at a presentation with an economist, and this was probably already 10 years ago. So it's 10 years ago. And the economist said, by 2030, everybody should be selling their businesses, hoarding the cash, because we will either have hyperinflation or our government will default on its debt. So just make sure your business is sold. So put that statement to the side. My question to you, Hank, is with rates as low as they are, and from what we are seeing, there doesn't seem to be any pressure to raise rates. What will be the triggers that we should be looking for when rates will probably begin to rise and we get out of this period right now that's so opportunistic? What's going to force rates to jump?
Yeah, there's a lot of downward pressure because of the structural changes we described. So in terms of what could cause them to jump, probably some base increase in costs, and that would likely emanate coming out of labor markets. We're going to see some political change, not just in this country, but across the developed countries. And there's going to be more pressure to provide more income support. And ultimately, as that builds, it'll cause some pricing pressure. But that's probably not for 3 years out at the earliest, Vince, given what we're going through now.
So do we look for like producer price index? What indices are we looking at to give us the heads up there?
Yeah, I would look at producer price index. Absolutely. I think that's the best leading indicator overall, Vince.
Thank you. Ben, tell us, what's your advice to an issuer that wants to accelerate a bond issuance but is just nervous about how the markets and if the markets are ready? And, you know, I think you even mentioned that there was a window that shut and there was a window that opened. And I know we owned a bank for a period of time. We went to raise some capital and we were told, oh, the window's open, and 30 days later, the window was shut. So talk to us about that risk of timing and issuance.
Sure, yeah. I think one of the points is if we are in that transitionary normal and rates are kind of here to stay, then maybe you shouldn't be in a great rush just on a rate perspective, but if you're ready to go and there's an open window and it's the right issuance to be doing for an organization, the markets are very supportive of that. As Hank alluded to, there's always market of forces and events, geopolitical events, elections, et cetera, that impact those types of variables, Vince, that are hard to predict. And certainly, nobody was sitting around in late February thinking, markets are going to shut, 3 weeks from now. So I think really just if you're ready, keep your timeline, maintain discipline, and come to market. And hope that you hit an open market. But as I mentioned, for assets and enterprise and authorities that we're largely speaking to, there is a broad kind of market, a broad investor base, and those types of market closures are really very rare. I think in the historical context, I think what happened earlier this year is probably, I think people will say once in a lifetime event, but at least once in 10 years. So I think maybe the bigger market windows than perhaps the bank example.
If we can just limit once in lifetime events to pandemics, I think we're going to be good. So Tanya, talk to us about the importance of the issuer being able to articulate their stress cases and understand them in its depth before meeting with the rating agencies.
Sure. Yeah, I think it's pretty important to come in for those conversations prepared to answer questions. So most borrowers or issuers of debt already know that they would need to prepare a forecast and they need it for their own budgetary purposes. But when they come to speak with the rating agencies, they're going to face some questions about why, what are some of the assumptions they've used in their forecasts and why they think these assumptions are reasonable. Because the more information that they're able to provide during these conversations, the more comfort the rating agency is going to draw from, your own forecast, and less potentially get less conservative on their assumptions. So if they feel that there's a lot of support for the assumptions you're making, if, for example, you're saying that there are revenue generating opportunities on the concession side, or you're expecting to see this much in cost reductions because of transition to electronic tolling or any other measures that you're taking, well, they'd want to see how did you derive at that number? You know, are there any independent opinions that you used in order to support these assumptions? And once they get more comfortable with your forecast, their forecast may potentially get closer to yours. So, you know, you're sometimes in the market, you're seeing rating agencies forecast very different outcomes than the issuers show in their base case analysis. And, you know, the question is, well, are they just assuming the worst case scenario? Not necessarily. It could be that, well, one, they don't agree with the forecast, but also because there wasn't enough information presented to them to support those judgments. So yeah, I do believe that we need to prepare for these conversations in advance, understand what their methodologies require them to look at, and be responsive to their questions.
Thanks, Tanya. Last question I've got, Amy, if you wouldn't mind, your board and our board is updated, it's told, and to be quite honest, the board looks at a refinance or refunding as a very simple process. And we know it's not, because of all of the work that you and your consultants and advisors do to make it appear simple to us. So peel that back and tell us what surprised you during the course of this effort. Was it simpler than you thought? Was there a takeaway that somebody should be implementing right now that maybe they didn't think about, that you went through, that we didn't have to see at the board level?
It's a great question. I've been around this for a long time and in the industry for, I'm not gonna say how many years, but only twice have I seen any deals go to market early for one reason or another, and they've both been me at THEA. So keeping track of things and making sure you can get in and you're flexible enough and confident enough to get in there was good. But that was because of the strong team that we had, and they had done a lot of front work with the investors. And what not surprised me, but given the negative outlook for transportation and the toll sector, they appeared to want our bonds. We were 5 times oversubscribed for the taxable, and I think they told a really good story. We told a really good story, and that's what I would recommend that people do, is really digging in with our traffic and revenue, because it's not the way it used to be. It's new. And you have to be really able to speak to that and your specifics, what's going on in your area, to be able to give validation to what you're presenting to them. And our team made it easy for us to be able to do that.
Well, thanks. We actually have a question that I want to read, but before I do that, did we get the response from the latest poll on refis? Have we seen that? 75%.
Also, Vince, you do have some questions in the chat room.
Yes. Okay. So 75% of the people have not refinanced their home in the past year. A lot of people with no debt on their home, that's for sure. So I've got one question here, and it's going on 3 o'clock. So I'm going to ask this question, and then this might be actually 2 people who have to take this. It might be Tanya, and it might be Amy. So we'll see. How are projected construction costs determined and evaluated in the bond ratings? Thinking that might be a Tanya question. And then, has the pandemic impacted construction costs to date, and what is the expectation for the future? Who's ever got a crystal ball would appreciate the second answer. But bond ratings, Tanya, you want to field that one?
Yeah, sure. So usually the rating analysts, so they're not engineers, so they would rely on independent opinions of an engineer to see how these costs were built up, so what are some of the certain individual line item costs and material costs that are included in the forecast. And oftentimes you'll see them make a more conservative assumption. So sometimes they would include a little bit more of a cushion in those costs to see that, if costs are higher, 10% or 15% higher than what was expected, what would happen with the coverage ratios and how much debt would need to be issued. So just really kind of, it depends type of response, and then depends on how much comfort they have in those costs, but they typically would include some sort of a sensitivity.
And anybody want to take a shot at that future?
Ben sees more than I do.
All right,
Well, yeah, it's obviously a very difficult one to answer. I think Hake's inputs on and comments on kind of on labor costs as a key and material inputs, very hard to tell, based on the severity and length of the recession, to what extent those are materially impacted for a long time, one way or another.
Barbara, I'm not pulling up the chat room here for whatever reason, because my screen is bifurcated.
All right, there's from Joe Wagner. Joe Wagner would like to know, will COVID have a greater or lesser impact on us than the Great Recession in the near term and long term?
Joe, I think you're the best one to answer that question. Why don't you answer it yourself?
Ratings presentation.
Then somebody would also like to know where the quote came from regarding 2030.
Brian Bailu, economist. He and his brother are twin economists from New Hampshire.
Okay. And then the last one, again from Joe Wagner, he says, he asks, do you see the presidential election as a significant factor in the tolling outlook?
I don't know, Hank. I'm going to pitch that one to you, brother.
Well, I don't know about the tolling outlook, but I can tell you this recession has had a much greater impact than the Great Recession. And as I said earlier, it's accelerating structural changes. So it just creates a lot of uncertainty. And it's going to create some uncertainty for you in the tolling environment because of the structural changes that are going to be accelerated. Finally, I do agree with you, Vince. I think there's going to be a significant rebound in activity once we have a vaccine. There is a lot of pent-up demand. But again, it's going to be highly differentiated by both income and geography, given the effects that this service sector recession has had.
So we're past 3 o'clock. We can always take all the questions that might be pending out there, get them answered, and produce that. So first, I want to thank Team Florida for pulling this together. I want to thank our panelists who gave some great insight, great discussions. Hopefully, there's takeaways. I think the two summary points that I'd like to leave you with is, we've already talked about it a couple times, transitional normal, right? That's what's going on right now. There's pent-up demand that's going to come. Be prepared for the opportunities that are going to be presented to you. Geography is, we just heard from Hank, they may be isolated areas, but be prepared. And number two, that great philosopher Pitbull is famous for saying, Mr. Right Now, right? So Mr. Right Now is the time to look at your balance sheet, look at your cash flows, and look at what opportunities exist that you can get into this market and take advantage of historic low rates, and whether that benefits your current structure or maybe it accelerates new projects. So just remember Mr. Pitbull, he's going to be Mr. Right Now. So you should be Mr. Right Now. That having been said, thank you to our panelists again. Thank you to Team Florida. Thank you for the Tampa Bay Lightning for bringing Lord Stanley back to its rightful place.